Okay. Welcome to this week's ETF report presented to you by the Stock Market Academy. My name is D'ron Forbes. This is the ETF report for the week of June 4th, 2021. And the goal here is to measure the inflows, outflows, the key performance indicators, right? Measure the volatility in the market, weigh out last week's performance, all the options ratios, gain insight, and prepare for the week ahead. All right. Now, today's key discussions are going to be how to use implied volatility and put the call ratios, total market performance, sector performance and indicators and measures, market support and resistance levels, expected volatility, and upcoming trends in the market, inflows and outflows from the previous week. All right, let's get right into it. Now, last week we saw the S&P 500 close out up 0.6%. But however, what we do notice is that its current implied volatility is a tad bit lower than historic levels. All right. Now, this shows us that there's not expected to be any major moves in the S&P 500 this week. We opened near record highs, which also explains the lower implied volatility that we are seeing currently. Now, let's talk about what implied volatility is, okay? Implied volatility is a forward-looking prediction of the likelihood of price change of the underlying asset, with a higher IV signifying that the market expects significant price movement and a lower IV signifying the market expects the underlying asset price to remain within its current trading range. Now, just a little hint for you, implied volatility normally increases when a stock's price decreases or as the stock breaks through major points of resistance. Now, look for higher implied volatility to signal a reversal or a move to the upside. Low volatility can signify an overbought market. All right. Getting back to the SPY, we must know that we can't just use implied volatility alone. And so I've put together a spread of information for you guys here that will really show you how I measure the market. So we see our stochastic levels, which is also somewhat of an overbought, oversold indicator, is sitting at 87.24%. Anything above 80% is considered to be overbought. And you add this with the lower implied volatility of the SPY, and this could tell you why the market opened slightly lower this week. All right. Now, the market does, the SPY does have support levels at the 419, 420 level. So if it does happen to dip that low, we could expect a turnaround and that it would head back up towards the closing price last week of 422.60, and even beyond that to 424 and setting new record highs. Now, our put to call volume ratio, it came in lower this week, which did show that more calls were traded on the market this week than we saw puts traded on the market. Now, the big thing here is that our put to call open interest increase, which now those two things combined kind of gave us the indication that we saw more puts being, more calls being closed out last week, more puts being opened, and preparing for what we're seeing right here, right now, today. And that's the beautiful thing about collecting data, putting it all together, and using it to help you understand what's going on in the market. But the put to call ratio, let's explain that. All right, the put to call volume ratio tells how many puts and calls options contracts are traded that particular day across all expiration dates. All right, now a high put to call ratio can signify the market is oversold, as more traders are buying puts rather than calls. And a low put to call ratio can signify the market is overbought, as more traders are buying calls rather than puts. All right, now a little hint for you: looking at the put to call ratios can give us an indication of investor sentiment. For example, if you see that put to call volume and put to call open interest is declining, this may mean that the volume represents puts being closed out. Okay, so that's just something to keep in mind. Now, moving on, the Nasdaq also closed out last week in the plus, up 0.5%. But what we see here is its implied volatility came in lower than historic levels. Our stochastic was above 80. So as you can see, same situation that we saw with the S&P 500. Looks like this is a key indicator of why we're coming down to start off the week. Support levels are at the 32, 33 level if it does happen to go that low. So keep your eyes out for that. You will see resistance at the 337, 336 levels. So be mindful of that as well. I do want to also point out we have an extremely elevated put to call open interest here, as you can see, at 2.15. So this is telling us that there are a ton of people out there who believe the Nasdaq is not done dropping. So we're going to keep our eyes open for that this week. There could be potential opportunities within the Nasdaq. They have managed to work their way a tad bit into the green this week. The last I checked, they were up a fraction of a percent, while the S&P and the Dow Jones still remain down. But some of this sell-off that you see may be a little unapparent at times, but it's there. In the opening hours, we saw the S&P, the Nasdaq, and the Dow Jones all open the day in the red. These numbers that you see here are affecting what's going on, whether you know it or not. Check your charts. Look at how the Nasdaq opened up the day. That was not by coincidence. All right, moving on, the Dow Jones closed out last week up 0.65%. But look at these stochastic levels, also above 80. Unlike the S&P 500 and the Nasdaq, we do see a closer correlation between the Dow's historic and current implied volatilities coming into the week. This tells me we may see a tad bit better performance from them this week. I'm not sure, but it's very, very possible. They are on the way down right now to start out this week, but they do have support levels at the 346, 347 levels. All right, and they don't have a very, very wide trading range. as we currently stand, their resistance is sitting at around 348. So again, you look at the stochastic telling us we're oversold. You look at our implied volatility on the low side of things, and then we see that we have a very, very short trading range between our support 1 and our resistance 1. I mean, you know, and it being that this the you know, the index, it closed out, you know, closer to its resistance. All these things, look at this. If everything is telling you we were likely going to open the week down, and we did, right? Let's keep it going. Let's keep it going. Now, inflow data for the previous week showed us that IXG and XLF brought in a combined $2.4 billion inflow into the finance sector this week. Now, finance is possibly overbought at this point. I mean, we've been seeing a hell of a run, but you know, we will be doing a deep dive into the XLF at the end of the week. We will see how things are looking there. Now, the Russell 1000 value ETF, VONV, brought in $939 million inflow, closing up 0.8% on the week last week. As we see more and more people starting to tap into that value, not only the Russell 1000 value ETF, but also the small cap value has been getting a lot of love, right? But here is the kicker for the week. International ETFs are leading the way right now in ETF inflow last week, as more value continues to emerge in these various different countries across the globe. And it's been something that we've spoken about in the past. We do know that the valuation multiples in these other countries are extremely lower than we see here in the US. Now, our outflow last week was led by none other than the QQQ outflows. We saw, you know, $1.5 billion lost in tech, still affected by threats of rising interest rates. We also saw the Russell growth, the Russell 1000 growth ETF, IWF, lost over $1.1 billion as more investors seek to trade in growth stocks for value. This is just what's going on right now. The government has decided they're going to start dumping some bonds. So bonds saw nearly $2 billion in outflows, including short-term and corporate bonds. You know, this is just what it's like right now. All right, now in our ETF weekly news right now, we do want to point out that the 2021 inflows are near $400 billion after having a very, very strong May. If you're not paying attention, let me catch you up, okay? People are starting to get a lot more used to diving in to these ETFs, as you know, the structure of the economy is changing. The structure of the market is becoming a lot more stable of an environment. We do know that right now it is a stock picker's market. And you know, at the academy, we talk about it all the time. You got to know how to pick a stock. Okay, if you don't know how to pick a stock, I'm not saying you're going to lose, but you're either going to match or underperform the market. Sometimes you can outperform the market if you do pick the right funds. I'm not saying that picking all ETFs is going to have you underperform or match the market. Okay, but the key thing to remember here is that these major ETFs are dropping all the time. In fact, we have a new ETF in FOMO, ticker symbol FOMO, sitting at gains after their debut. I think they debuted 2 weeks ago. They're up 2% on the week last week. So that gave them their first weeks of gains, and they're looking pretty decent right now. The ETF is actually not what you may think. This isn't the fear of missing out ETF. This is the let's benefit from everybody else's fear of missing out ETF. What they do is they actually work the short side of FOMO plays. I absolutely love it. If you're not great at shorting investments yourself, this investment here may be something that you might want to look into. From what I understand, their goal is capital appreciation, although I do believe at some point in time they will launch an ETF. All right. Now, the Defiance Hotel, Airline, and Cruise ETF, ticker symbol CRUZ, debuted June 4th. All right, last week. Here we go. Yet another opportunity for you guys to get in early. All right, and that's kind of the beauty of ETFs. You get in early. You're buying a basket of stocks. You're not just buying into some of this new age IPO that you see going on right now, the whole Coinbase debacle. You're not doing any of that. You're really buying into a basket right out the gate at IPO, and so that kind of gives you some opportunity to invest and let that capital appreciate. As you can tell by the title, this is somewhat of a reopening ETF that seeks to invest in what they believe are the best reopening plays of 2021. Right, now moving on, this week on my watch list, what I'm going to be looking at is XLV. This is the S&P 500 healthcare sector. All right, now last week they were down 1.22%. All right, their current IV closing out last week was above historical levels. All right, they also opened up down today, so that IV should be picking up a little bit more. And their stochastic levels, look at this, 19.06%. So, definitely not overbought right now. And just giving us a really great opportunity to benefit from the hell that healthcare has been going through. They did start off the week on the way down. Support levels are at around 120, 179. So keep your eyes open for that. Resistance is at a 122.54. They closed out last week at 122.09. So that range is very tight, but there's still money to be made there. I do believe when they do go to the upside, this resistance level probably won't hold long. As you can see, our put to call volume ratio is showing us that at a 0.86, far more calls were traded last week than far more calls were traded last week than puts. But however, we do still have a certain amount of puts open out on the market. I do believe these, we will see this number come in lower by the end of the week, and we'll be able to see the XLV take off. Next, that's also on my list this week, is the XLP S&P 500 Consumer Staples ETF. Yes, they do have a stochastic level above 80, but if you judge it on a lot of what we saw during the course of this ETF report, that's not, at the extreme high levels. Also, I kind of knew that they would open up this week coming down. So I believe that stochastic level should be decreasing as we speak. Okay. Now, also, I want to point out that our implied volatility is slightly above historic levels, right? As you can see, it's slightly above historic levels, and our historic levels on this particular sector of the market is not traditionally that high, right? So this tells us that this could be gearing up for a tad bit of a move to come soon, and we will see what happens from there. Now, they closed out last week at 71.52. They do have support levels at 71.31. As you can see, there's not a very wide range here in terms of support and resistance, but when this sector moves, they move all the way. They spend weeks on top of weeks to the upside. I'm going to be looking to catch a bottom here sometime this week, maybe at a lower support level. If they happen to break below this support level, currently they are trading at 71.15. So yes, they actually have broken below this support level, as I thought they would. And the next support level here is 71.10. They could go as low as 70.92, right? Which is their third support level. We'll see what happens. Of course, I hope for the best for everybody that's invested in the market. I'm not wishing the downfall of the consumer staples market. All right. I'm just saying I would like to find a great entry point. All right. So now I just want to say thank you. I appreciate everybody for tuning in, checking out this week's ETF report. Next week, we are going to focus on more sectors. We're going to be taking a look at, we might even take a look at all the sectors. We'll see. All right. Now, the Stock Market Academy was built to show individual investors the full potential of the stock market. We strive to enhance financial literacy across the globe. However, it is important to note that this is not financial advice. This is simply financial information. Please be sure that you do continue to build upon this knowledge and use other resources to enhance your growth. All right. Again, my name is D'ron Forbes, and we are out.